Hi, Michael Yard here, and welcome to another Ask the Expert session. Today I'm having a chat with Ken Race from Metropole Wealth Advisory. Hi, Ken.
Hi, Michael.
Now, we've had a question sent in by Edith Golden. She's asked the following, Ken. My grandmother died in the early 90s and left her home, and she said it was pre-GST, to my mother, who kept it as an investment property ever since. Now, I've inherited it from my mother when she died earlier this year. How's this property treated for capital gains tax? And thanks in advance. Well, thank you very much for your question, Edith. And guys, if you've got a question, you can always leave it at the bottom here in the comments section on the website. But Ken, I guess it's a general question about capital gains tax, but this one's a little bit more complicated.
A little bit more complicated, but it actually shows you the value of property as an investment tool, that it can actually go from one generation to the next and then again. So the home is normally tax-free when you sell it. So that's a general principle. But on the death of your grandmother, your mother would have picked it up at the market value at the date of death. And therefore, when she passes it on to you, it's that market value at the date of death of your grandmother that gets passed to you. So over that lengthy period, hopefully there is a significant capital gain. And then that would be the price, the market value, less that cost at the date of your grandmother's death, which would then create the capital gain for tax purposes. There would be the general 50% discount to apply to that, and then you would pay tax at your marginal tax rate on that remaining 50%.
I think that's a good point, Ken, because most people don't realise, or they wonder, what is the rate I pay capital gains tax? And there isn't actually a capital gains tax rate, is there? It really has to do with what your current tax rate is at the year. So sometimes, especially if you're coming closer to retirement, you can plan the timing of the sale to legally postpone the capital gains tax to a year where it would be more favourable, Ken.
Correct, because for tax purposes, the date of sale is the date of contract signing. Some people call it the date of exchange. So if you exchanged in mid-June, then that's the year that you would be triggered the tax. Had you pushed it to the 1st of July, you're almost postponing it another 12 months. So very crucial to look at the date. And if you've got some ability to move that a little bit to your advantage, there's nothing wrong with that.
Now, Ken, I bet you Edith's thinking, I don't know what the value of the property was when my mother inherited it years ago. And I think that's an issue that we sometimes have because her mother probably didn't think to get a valuation. If one was to inherit something today, what advice would you give to make it easier for your kids in the future?
Well, I think whenever you pick up an asset or if you change its use, so you might have a home that you now move out of and turn it into an investment property or pick up a property from an inheritance, you should always get a valuation done at that time. It's going to be a bit difficult now because you've got to go back over such a long period. Normally, you could have gone to a real estate agent and got an appraisal, but I think if you have to go back so far, it would probably be better to go to a registered valuer who's probably got the records and the ability to go back that far and then put a market value at that date of death.
Fantastic. Thanks for answering that slightly complicated question, Ken. I look forward to catching up with you next week when we do another Ask the Experts question.
Yes, thank you very much.